Hello and welcome to my next review of the war in the markets. Today, the 2nd of June. A very interesting day in the markets. Started off with a very bad start for the markets today, but around noon, the markets showed a sharp bounce back and recovery. The Nifty ended about almost 0.8% higher. Did better than the mid cap and the small cap indexes, which were, I think, about 40 basis points and 20 basis points higher. But micro caps were the best performers with more than 1% positive returns. The advanced decline ratio of 1700 stocks rising to 1200 stocks falling indicated that retail and HNI participation was very strong today. Well, the FIIs obviously in the morning itself started selling. So their selling was around 8,000 crores today, massive amount of selling. But the DIIs stepped in and matched them step for step with about 9,500 odd crores of buying. So clearly the DIIs stepped in later in the day, allowing the FIs to sell the stocks and correct a bit before stepping in. Was it a smart strategy on their part? Well, most probably yes. But then what actually happened today was that there was one single sector which pulled the market up, and that was the IT sector with a 4% gain today. The rest of the market was broadly positive, and the interesting thing was that just yesterday we discussed IT sector also in detail yesterday, but in addition we also discussed the fact that yesterday rate sensitives had corrected because of the apprehension of the RBI policy and a fear of the monsoon being deficient. But today the tables were turned. Today was extremely risk on. Every rate sensitive sector was up, and in fact, the only sector to end in the negative today, in a way, was the FMCG, the pharma sector, which is traditionally a defensive sector. So clearly, it was a risk on mode. Private sector banks also were a bit negative today. But it's very, very interesting, and it deserves a bit of a deeper down analysis today. So, what is the first of all the geopolitical backdrop? Geopolitical backdrop was that Israel did an attack on Lebanon, according to which Iran then said that all the ceasefire talks is off because this is a violation of this. Because to them, a solution is not just about Hormuz, not just about Iran and America, but it's about Israel, Hezbollah, Lebanon, all of that being on a ceasefire. So the strong Iranian reaction and the fact that they had put a proposal which Trump is yet to sign. But when Iran reacted strongly, Mr. Trump actually, contrary to expected belief, picked up the phone and spoken to Mr. Netanyahu and fired him for actually hurting the ceasefire talk. So clearly, what came through was that while Trump has not signed on it, he's close to signing on it, and he's just waiting to get a little more assurances on the nuclear enrichment part before he gives the green light to this. And so he apparently has got an assurance from Mr. Netanyahu that if Lebanon and Hezbollah don't attack, he will not take it forward. So that is the oil market. So oil markets were into a range bound between 92 and 95, ended up close to 95 today. So I think probably during the course of the day, these developments helped get a risk on. And the US markets, of course, have been on a tear over the last few days. So this FII is selling into India, whereas the rest of the equity markets are on fire, clearly indicates that they believe that this oil at 92, they are not comfortable with the way the fiscal situation is panning out. I think we discussed that also yesterday, so I'll not dwell too much into that. But what is interesting is that DIIs now, with the earnings season pretty much over, are now ready and free to deploy their cash. Now, the earnings season results are there and those deployments have happened. But what I am seeing over the past few days is that though the RBI policy initially was expected to be hawkish, what is happening, I think clearly, is that DIs are now saying that the correction has been pretty significant. If you take two sets of data I was looking at, one was the 3 month period, which is since when the war began, and second is YTD from the beginning of the calendar year, this year. And if you see what bounced today was more or less those which have corrected the most, right? Now the worst performer from YTD is clearly IT sector, but that's at 17% because IT sector has actually gained 7-8% over the last 3 days. So the first correction, the reaction that's happening is that I see that those sectors which have corrected very strongly, either from the beginning of the year, like IT, realty, FMCG, and all of that, or those that have reacted since the beginning of the war, where the worst performing is the PSU Bank Index down 17% and private banks down about 7-8% since the last 3 months, right? So what is happening now is that domestic investors, whether they be retail or HNI or proprietary books or of the DIIs, they are now looking to buy sectors which have corrected the most because they are flush with liquidity and they want to deploy. The FIS, on the contrary, are still holding negative because they have other opportunities in a risk-on environment to choose markets which are much better off from both valuation perspective and their perception of AI readiness. Now, the IT recovery has also got something to do with the news which I spoke about yesterday. So lots of IT companies are giving out news that they are working on the AI front and they are working on a lot of AI related projects, and that their customers are willing to give them the right of first refusal in bidding for this project and help with the AI transitioning. I think so. That's where even the Nasdaq ended on a very lifetime high probably yesterday, and that wind is given the DIIs the confidence to go and load onto IT because of the severe correction that's happened. I don't think FIs are still buying IT with 8,000 crores of selling today. I'm not sure what they've probably been selling IT, but it's the domestic investors who are now looking at IT as a value buy, and the fact that the doomsday scenario earlier painted out is not going to be anywhere near as bad as expected, and the IT companies will still survive in some form or the other. So I think very interesting way the markets are playing out, and so well, we have another couple of days to go before the RBI policy, by which time you'll know a lot of RBI's thought process, GDP outlook, inflation outlook. So the markets, as usual, have been very unpredictable and are displaying the signs of an impatience driven by liquidity to go and buy that which has corrected the most. And when the actual data, I would say Friday, when RBI speaks at the policy meeting, a lot of things about the future will get clear. Because I, for myself, have a lot of confidence in the way RBI does its forecasting and assessment. So let's wait for now the Friday. Until then, there's no need to do anything. It's good that the markets have bounced today and there is enough liquidity in the domestic to keep sustaining the market in the way forward. On closing, I just want to mention about the rupee. Slight weakening today of 20-25 basis points to about 95.28. But the DXY index, the US 10-year rates, Indian 10-year rates have more or less been flat. So nothing much on the currency front has happened, and that's why you saw that IT and pharma, the two currency hedges, behaved completely opposite today. So the currency was not the driver for their performance today, right? I think pretty much I've covered everything in the markets today. So let's look forward to another good day tomorrow. Look forward. Thank you.